Developing story this morning for homeowners, those who've borrowed money from a bank, and whoever does the weekly grocery shop at your house. The Reserve Bank issued the official cash rate, increased it 50 basis points yesterday, as expected. But what many pundits didn't see coming was this: a shorter, sharper, more aggressive hike to the official cash rate trajectory. In April, Governor Adrian Orr said it'd peak at 3.4% by September of 2024. Now, higher at 3.9%, and more than a year earlier, June 2023. Joining us now is the Governor of the Reserve Bank, Adrian Orr. Morena, good morning.
Morena.
Why the change to that track?
The change really reflects the inflation pressure that is now in the economy, a large part because of what's happening globally, extremely high food and energy prices feeding into actual CPI inflation. And likewise, demand still is growing and outpacing our ability to meet that demand, to supply the goods and services within New Zealand. So we're seeing persistent inflation pressure, and what our task is to make sure that inflation comes back down to within the 1 to 3% target band. So we've decided to go earlier and harder, really as a stitch-in-time policy.
Yeah, this is the thing, because the economists we've spoken to this morning say that, there is a risk with this trajectory that you do, over-restrain the economy and cause a recession. Would you be willing to sacrifice a recession in order to maintain inflation, get inflation down?
There's a risk to any projection, and the great news is that, we're back every 6 weeks, adjusting and learning as we go, observing what's happening. So, the projection out for the next couple of years is our best foot forward at the moment. What we are unwilling to put up with is inflation becoming embedded. Current high CPI inflation is creeping into people's expectations about future inflation, and we're saying, no, that is not the case. We're going to be 1 to 3% inflation now and ongoing for this economy, as opposed to the very high current level of inflation. So,
and that's at any cost. Even recession?
Well, no, our task is to do it without undue instability in output, interest rates and the exchange rate. This is why we are focusing on inflation over the medium term. Current CPI inflation is 6.9%. That's in the tin. We're talking about inflation not returning to the target band until late next year, below 3% and near the midpoint by the year after. So, the economy needs to slow at the growth rate, but we are very resilient in the economy. Extremely high levels of employment, very sound balance sheets, very high terms of trade. We have got the resilience to manage higher interest rates, to slow demand down somewhat and get rid of this inflation.
Is your job made harder by the government? We've just had the budget. You taketh, Adrian, and Grant giveth.
I think that's far too simplistic and, in fact, wrong in a sense.
I'm quite a simple person, so bear with me, yeah. Adrian.
No, that's and I was deliberately putting it there because government fiscal policies are both about long-term infrastructure and all of the challenges. It's about making sure even the current level of services can be supplied. There's so much complexity around the government balance sheet, but without doubt, they are a big part of spending in the New Zealand economy. The recent budget says spending is up somewhat, but when you look ahead, the actual impost from the government's fiscal policy starts to wane over the next 2 years. Higher starting point, upward pressure on demand, but then waning through time. The biggest challenges to us, so that's happening, but it's a very small part of the total picture. The big picture is going on as global inflation pressures and a lack of supply, and that supply constraints are very evident in New Zealand, especially people. We have extremely low unemployment. Scarcity of labour is the number one constraint on economic activity. We are growing faster than what we can supply.
That's one of the issues that's affecting house prices, right? Because although we expect a 10 to 15% drop in house prices, there are these shortages of both labour but also materials. How much do you think those shortages are going to affect the price of our properties?
That's a real challenge. It's right here, right now. We've all heard about the jib and different types of building materials that are in incredibly short supply, slowing the rate of development. But at the same time, we are at a record level of building. So the supply of housing is increasing at an historically fast rate, and that is a good thing. The Reserve Bank has been under pressure for exactly the opposite of what you're questioning me today. House prices are rising, they're becoming unaffordable, and now people are saying, oh, house prices are declining, what we're saying is perspective, please. Step back. House prices were well above any level of sustainability. House prices are now moving back towards a more sustainable level. That is a good thing, and in large part because the supply of housing is increasing. And so that is a long-term structural change that is necessary. Meanwhile, in the cyclical sense, building those houses uses up resources. There are costs around construction, challenges to finding people to build houses. And so that's where the near-term demand is running ahead of our capacity to supply.
Yeah, interesting. Hey, thank you very much for your time this morning. We appreciate you on the show, as always. Reserve Bank Governor Adrian Orr.